In the year 2000, Enron reported revenues of nearly $101 billion, employed more than 20,000 people, and received Fortune magazine's recognition as America's most innovative company for the 6th consecutive year. 1 year later, the empire filed for bankruptcy, and the scale of institutional fraud hidden inside those numbers made Enron a permanent lesson in corporate collapse. Enron began as a merger between two relatively small regional energy companies. Houston Natural Gas had built pipelines serving the Houston market since its formation from the Houston Oil Company in 1925. InterNorth, formed in Omaha, Nebraska in 1930, expanded over 5 decades into the largest pipeline operator in North America. By the early 1980s, both companies faced pressure. Houston Natural Gas struggled after the Natural Gas Policy Act of 1978 reduced profitability in the Texas market. InterNorth, despite conservative success, became a takeover target. When InterNorth CEO Sam Segnar needed a defensive merger to fend off corporate raiders, he turned to Houston Natural Gas. The 1985 merger created Enron, and Kenneth, who had taken over Houston Natural Gas just a year earlier, became the leader of the combined entity. The timing mattered. Natural gas deregulation was beginning, and the merger created one of the first companies positioned to move gas across state lines in a newly flexible market. Enron's breakthrough came from rethinking what an energy company could do. Rather than simply owning pipelines and selling gas, Enron became an intermediary. It created a trading desk where producers and consumers could lock in future prices, transferring risk from clients to Enron's balance sheet. The model worked because deregulation had created volatility, and volatility created demand for certainty. Enron offered contracts that smoothed out price swings, earning a spread on each transaction. The innovation turned a commodity into a financial product, and Enron controlled the marketplace. By the mid-1990s, the company expanded the model beyond natural gas. It launched trading desks for electricity, water, broadband capacity, and even weather derivatives. Enron Online, a digital trading platform introduced in 1999, allowed clients to trade directly with Enron 24 hours a day. The volume was staggering. At its peak, Enron Online handled transactions worth $6 billion daily. The flywheel fed itself. More trading generated more data improved pricing models, better models attracted more counterparties, and scale reinforced Enron's dominance in every market it entered. At the end of 2000, Enron's reported revenue had grown to $100.1 billion, up from $40 billion just 3 years earlier. The stock price reached $90 per share in August 2000, giving the company a market capitalization above $60 billion. Fortune's repeated recognition as America's most innovative company reflected Wall Street's belief that Enron had cracked the code on asset-light, high-margin growth. The company's leadership presented Enron not as a pipeline operator, but as a technology-driven market maker, a narrative that commanded a valuation multiple far above traditional energy firms. But the reported numbers concealed a structural crack that had been widening for years. Enron relied on a network of off-balance sheet special-purpose entities to hide debt and inflate profits. These partnerships, with names like Chewco, LJM, and Raptor, allowed Enron to move liabilities off its own books while booking gains from transactions with entities it effectively controlled. The accounting treatment was designed to meet the technical letter of disclosure rules, but it obscured the economic reality. Enron's reported earnings included profits from selling assets to partnerships funded with Enron's own stock, a circular structure that collapsed the moment the stock price declined. The rising stock price wasn't just a consequence of Enron's success, it was a necessary input to the accounting that created the appearance of success. Under that pressure, Enron made choices that compounded the structural weakness. Executives expanded into markets where the company had no operational advantage, including broadband services and international power projects that consumed capital without generating the promised returns. Enron's broadband division, launched with significant fanfare, failed to build a sustainable customer base, yet the company continued to book projected future profits as current revenue. When deal flow slowed, the pressure to maintain growth targets pushed financial engineering further. Chief Financial Officer Andrew Fastow created additional partnerships and personally profited from his role in managing them. A conflict of interest that should have triggered oversight, but instead received board approval. The unraveling began in the spring of 2001. California's energy crisis and the dot-com collapse reduced trading volumes and strained Enron's liquidity. In August, CEO Jeffrey Skilling resigned abruptly after just 6 months in the role, citing personal reasons but offering no detailed explanation. The sudden departure raised questions among investors and analysts who had been told the company was thriving. Then, on October 16, 2001, Enron announced a $618 million third-quarter loss and a $1.2 billion reduction in shareholder equity related to unwinding certain partnerships. The company attributed the loss to failed investments and accounting corrections, but the announcement shattered confidence. Credit rating agencies downgraded Enron's debt, which triggered contractual obligations requiring the company to post additional collateral it did not have. Trading counterparties, suddenly aware of Enron's fragility, pulled back, which dried up the transaction volume that generated cash flow. Enron's stock, which had traded above $80 per share at the start of the year, fell below $1 by late November. On December 2, 2001, Enron filed for Chapter 11 bankruptcy protection in the United States District Court for the Southern District of New York. At the time, it was the largest bankruptcy in American history, with $63.4 billion in assets listed in the filing. The collapse triggered investigations that revealed systematic accounting fraud sustained over years. The Securities and Exchange Commission and the Department of Justice brought charges against multiple executives. Kenneth and Jeffrey Skilling were convicted of fraud and conspiracy in 2006. Andrew Fastow pleaded guilty and cooperated with prosecutors. Enron's auditor, Arthur Andersen, was convicted of obstruction of justice for shredding documents related to the Enron audit, a verdict that effectively ended the firm's operations and dissolved one of the largest accounting partnerships in the world. The Enron scandal, combined with the even larger WorldCom fraud discovered shortly after, prompted Congress to pass the Sarbanes-Oxley Act of 2002, which imposed stricter financial reporting and auditing requirements on public companies. Enron emerged from bankruptcy in November 2004 under a new name, Enron Creditors Recovery Corporation, with a mandate to liquidate remaining assets and distribute recoveries to creditors. By September 2006, the company had sold its last subsidiary, Prisma Energy International, and ceased to exist as an operating entity. Employees lost jobs and retirement savings that had been heavily invested in Enron's stock. Shareholders recovered pennies on the dollar. The brand, once synonymous with innovation, became shorthand for institutional corruption. The lesson Enron left behind is precise. When a business model requires continuous growth to mask structural insolvency, and when the accounting that reports success depends on the very stock price that success is supposed to justify, the system contains its own collapse. Enron's executives made choices, but those choices unfolded within a structure that prioritized reporting metrics over cash generation, where off-balance sheet complexity concealed risk until the risk became unavoidable. The empire fell because the foundation was accounting, not economics, and eventually the difference mattered.